Hey everyone, welcome back to Corporate Decoder, the place where we help you see through the corporate jargon and understand what's really going on behind the scenes. Today we've got Kartoon Studios, and let's just say their latest filing is a bit like a cartoon plot twist, involving a significant debt payment made with their own stock. So what's the big story here? Kartoon Studios, the company behind some of your kids' favorite animated shows, has entered into an agreement to settle a pretty hefty debt. We're talking almost $1.8 million. Now, instead of paying with cash, they're handing over stock. This is a common move when a company might be a bit tight on cash, but the details of how and when this happened are pretty interesting. Let's dive into the core of this report. We're looking at a filing that tells us Kartoon Studios had to pay off a debt of roughly $1.8 million. Instead of cutting a check, they're issuing up to 315 million shares of their common stock to a company called Continuation Capital Inc. Think of it like this, they're essentially trading their company's ownership pieces for a past debt. This deal wasn't just a handshake though, it went through the courts. A judge in Florida gave the thumbs up to this agreement back in August. This court approval is important because it adds a layer of legitimacy and oversight to the transaction, especially when a company is dealing with its financial obligations. The deal officially became binding on September 2nd. This was the date the NYSE American, the stock exchange where Kartoon Studios is listed, gave its final approval for issuing these new shares. Getting exchange approval is crucial. It means the stock issuance meets the exchange's rules, which often include ensuring there's a valid business reason and that the process is fair to existing shareholders. Now here's where we touch on how this stock is being issued. The filing tells us these shares are being sold without being registered with the SEC first. This is allowed under a specific part of securities law, section 3(a)(10), which often applies when a court needs to approve the issuance of securities in exchange for a debt settlement. The rate here is set at 1.75 shares for every dollar owed, so for that nearly $1.8 million debt, they're giving out a lot of stock. This specific exemption means that because the deal was approved by a court, the shares don't need the usual lengthy and expensive registration process. This can speed things up for the company when they need to make these kinds of settlements. However, it's important for investors to know that these shares are being issued in a less transparent manner compared to shares sold in a registered public offering. The actual agreement and stipulation that outlines all these details, dated August 27th, is included as an exhibit. While we don't have time to go through every single line of that legal document, it's this agreement that contains the nitty-gritty of the debt settlement. It's the paper that makes it all official between Kartoon Studios and Continuation Capital. Signing off on this report is Andy Hayward, the Chief Executive Officer. As the CEO, he's ultimately responsible for the company's decisions, including how they manage their finances and settle their debts. The date here is September 5th, just a few days after the NYSE American gave its final nod. Now, let's put on our investor hats and analyze what this all means for Kartoon Studios. They're settling a significant debt by issuing new stock. On the surface, this can be seen as a positive move because it resolves an outstanding obligation. It also means they're preserving their cash, which is crucial for any company, especially one in the entertainment business that might have fluctuating revenues. However, issuing a large number of new shares can dilute the ownership stake of existing shareholders. If you owned a piece of Kartoon Studios before this, your percentage of ownership now represents a smaller slice of a bigger pie. This dilution can drive down the stock price if the market doesn't believe the company is gaining enough value to offset the increased number of shares. We need to consider the context. Kartoon Studios operates in a competitive market. While the specific details of the debt aren't fully elaborated on in this particular filing, knowing they had to resort to a stock for debt swap suggests a potential cash flow issue or a major expense that needed immediate attention. The fact that this was approved by a court and the NYSE is reassuring that it's not a sign of outright financial distress, but rather a strategic financial maneuver. The key question for investors is this: will the value generated by Kartoon Studios in the future be enough to make up for the dilution caused by issuing all these shares? If their upcoming shows and projects are blockbusters, then perhaps this stock issuance will prove to be a wise decision in the long run. If not, existing shareholders might feel the pinch. Looking at this report, the story is clear. Kartoon Studios is facing financial pressures that required a creative solution to pay off debt. They've used stock, which is a common tactic, but one that always comes with the trade-off of dilution. The company's ability to execute future projects and generate revenue will be the ultimate deciding factor in whether this move pays off for shareholders. The upcoming earnings reports will be especially important to watch to see how this impacts their financial health. Alright, that's our breakdown of Kartoon Studios' latest filing. What's your take on these numbers and what they signal for the company's future? Do you think issuing stock to paid debt is a smart move for Kartoon Studios or a sign of deeper issues? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.